Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about long-term debt and the way it shows up on our income statement and our balance sheet. We've talked about the importance of debt financing. We've talked about how we do journal entries for bonds and for mortgages. We've talked about retirements and conversions and done all sorts of examples to help solidify the concept of how we treat debt for financial accounting purposes. Now, to wrap up this discussion, we need to talk about one last topic, and it's one we've alluded to already in our very first segment. But now I want to talk about it in a little bit more detail. That's the fact that companies try to shift as much debt as possible off of their balance sheet. It's not because debt is bad. Debt is actually a good thing. It gives extra financing, it keeps the owners from having to provide all that extra funds, it provides a financing source that you can pay back with just interest. You don't have to give back interest and part of your revenue stream, right? The profit that belongs to the investors. But it still has a negative connotation for a lot of investors because of the risk associated with default. So companies have this tendency to try to slide it off. We call it off-balance sheet financing, and companies actually have a lot of reasons why they think it's appropriate. We're going to talk about some of these reasons why companies think it's appropriate to do off-balance sheet financing. Now, I'm not trying to convince you that it's good or bad. I just want to make sure you understand the logic that companies are using to argue with FASB about whether or not different liabilities should show up on their financial statements. Keep in mind, this has become such a hot issue, and there's so much push back and forth between companies and regulators and auditors and academics that it really has become a key concept in our discussion of debt. So here is the logic that companies use when arguing with FASB and with others who are trying to push them to report more than they're currently reporting on their balance sheet as a long-term debt balance. Their first argument is that it actually improves the quality of the balance sheet if we leave some of the debt off. And that allows us to get easier financing. Now, when we talk about quality being improved, we're not talking about quality as in it provides more information. We're talking about quality as in it looks better. And if our balance sheet looks better, we can get easier financing. Easier financing is better on the bank because they don't have to spend as much money trying to figure out if we're a good investment or not. It's better on our investors because they don't have to pay as much to the banks, so they get to keep a larger share of the profits. It's better for us as management because we don't have to waste our time trying to get the financing that we need. So that's one argument. The second argument is it makes sure we don't violate our loan covenants. A lot of loan covenants have a restriction on the debt that you're allowed to show. You can only have X amount of other long-term debt beyond this loan or something along those lines. So companies that can shift some of this debt off their balance sheet, they keep from violating their debt covenants, which saves the bank a lot of time and effort to recall. And they don't have to do as much analysis, and we don't have to try to renegotiate. It's always better for our owners if they don't have to pay the fees associated with a debt recall or have our credit rating downgraded. The final argument is perhaps the most persuasive of the three, and that is the fact that the assets of the business are already understated. Some of them aren't recorded, like the intangible assets that we talked about in an earlier lecture. Many of them are recorded at historical cost. They appear to be much smaller on our balance sheet than they really are. So why should we have to show our debt at current value if we're showing our assets at their old historical value or not showing it at all? It makes our balance sheet lopsided. So if we can shift a little of that debt off the balance sheet, then it makes it more fair, and we get a better picture of what our company really looks like because we've made both assets and liabilities look a little smaller. Whether you believe these arguments or not, companies have a lot of legal means or financial accounting means to legitimately remove their debt. It might not be ethical, but it is legal or legitimate from an accounting perspective, however you want to think about it. So one of the best ways that companies can still do this is with their leases. Leases, of course, are a long-term agreement to rent something from a different company. But if we structure it just right, we don't show that as a liability. We just debit a rent expense and credit cash every period as we send our checks. So even if you're locked into a 10 or 20-year lease, you could still not show that obligation on your balance sheet if you follow the rules just right. A lot of companies have been very careful to structure their leases so they follow these different rules and slide off the balance sheet. One of the best examples of this is one I believe we mentioned before, and that is FedEx. We've all seen the FedEx trucks, the planes, etc. None of those show up on FedEx balance sheet as assets, and the liability that they have for leasing all of these items don't show up as liabilities either. So leasing, again, is one of the most common ways that companies eliminate debt from their balance sheet. Now, in addition to the legitimate or legal ways that companies can slide debt off their balance sheet, there's also some ways that are much closer to the border. And the best examples of these actually come from Enron. Now, Enron was a great energy trader, had a lot of things going for it, but slowly its culture shifted so that they started using accounting tricks instead of legitimate business practices to make a profit and to keep their balance sheet looking good. So there are many, many examples of the ways that they would keep debt off their balance sheet. We're going to look at just one simple example, and you'll see quickly just how complex some of the others had to be if this is simple. So let's start off with Enron. Enron needed a loan, and they were worried about getting this loan because they didn't want the extra debt on their balance sheet. They didn't want to violate a debt covenant or drive up some of their ratios. So what they did instead is they created this special purpose entity. Now, a special purpose entity is a special kind of company. Basically what it boils down to is two different companies or an individual in a company getting together and saying, you know, we need extra widgets. Nobody out there is producing the widgets that we need. I don't have the money to do it, you don't have the money to do it. What if we each put up just half the money and we'll create this special entity that only produces widgets? Now, if we produce it and it loses money, that's okay. We're only on the hook for half of the money that it loses. And if it makes money, at least we'll get half of the gain. This could be a really good thing for us. Well, one of the negatives of a special purpose entity is the fact that if you own half and I own half, neither of us controls it. And from an accounting perspective, since nobody has control, it just kind of disappears. And nobody really shows this entity or its assets. And that's what Enron was trying to use. Not the special purpose, let's do something that's good for us portion of a special purpose entity, but instead the let's find a way to make this disappear. And that's what they did with these entities. And they did quite a few of them. And by structuring them so that Enron owned half and one of their employees owned half, then they still essentially controlled this special purpose entity. So in order to create the special purpose entity in this example where they needed a loan, they took the asset they wanted to use for collateral and they used it to help found this special purpose entity. And in exchange, they received a bunch of stock from this special purpose entity, which gave them their voting control. Then what they did with that stock is they went to another special purpose entity. They didn't create this one, it was already out there, but they took the stock, not the voting stock, but like preferred stock, where you were entitled to a dividend, but you don't really have any voting rights, and they sold that stock to this other special purpose entity. Well, the special purpose entity says, oh yeah, we'd absolutely love to buy this stock from you. It's a great idea for us as an investment, but we don't have the cash right now. So let's go to the bank and we'll get the bank to loan us the cash. And we'll then give that cash to Enron. Well, the bank looked at this loan and they went, you know, this really is kind of risky. I mean, all you have is some stock in another small company. Remember, this is not Enron stock. This is the special purpose entity one's stock. And the bank was a little worried about it. They said, you know, that special purpose entity one stock, I don't know if they're really going to produce enough value to repay this debt. So Enron stepped in with what we call a derivative. And a derivative basically is a way to offset risk. And essentially Enron guaranteed that they would cover any defaults in the interest that this special purpose entity 2 had to pay to the bank. And the bank said, well, if we've got a derivative that ensures that the interest will be paid, all right, we'll accept that. And they would loan the money to special purpose entity 2, which would then give the money to Enron. Now, if you look at what's happened here, Enron has really used an asset as collateral for a loan. That's what's really going on. But because of the way they structured it, they not only avoid showing the loan, but they get to show sales revenue from selling off this stock to the subsidiary. Not only have they avoided the debt, they get to show revenue for this. And they don't even have an interest expense to worry about later on. They just have to cover the interest payments if special purpose entity 2 can't quite make them. Ingenious, isn't it? You got to wonder, as you think through this transaction and others that were much more complex, at how well Enron would have done as a business if they'd spent their time and intelligence and creativity providing business services instead of accounting tricks. Now, since Enron took such advantage of this special purpose entity opportunity, we'll say, under the old GAAP rules, FASB has actually closed this loophole, and you can't just make these entities disappear. anymore. So slowly but surely, we're finding ways to reduce companies' opportunities to get the balance sheet free of some of this debt. One of the other ways we've done it, or are working on doing it, closing this loophole, is we're trying to restructure the lease accounting rules so that everybody has to, what we call, capitalize their lease, which would mean that you would show the asset and you would show the lease liability. That one's still very much up in the air. There's a lot of pushback against what FASB is proposing, so we'll see what happens. But because of companies like Enron, we are trying to close some of these loopholes. Now, despite companies' attempts to shift financing off of their balance sheet, there are some good ways that we can use to analyze our debt and how much debt a company's carrying. Perhaps the best of these is the debt to equity ratio. Now, the debt to equity ratio is basically the total liabilities divided by the total equity. What we're showing is how many dollars of debt we have for every dollar of equity. That's the best way to interpret it. So if you have $1 million in liabilities and $1 million in debt, you have a ratio of $1 of debt to every dollar of equity. Most investors want to see some long-term debt. They want to see some long-term debt because they want to know that you're leveraging their money to make them more money. If I can take out a loan, I don't have to get the money from the investors, and if I can make more than the interest payment, then that profit rolls back to the investors, the owners. That's what owners want to see, but they don't want to see too much of it. So a smaller value is in this debt to equity ratio is usually considered less risky, but most investors don't want to see it as 0. They want to see it around 1, perhaps maybe about 0.5, 1.5. It depends on the industry, how much debt they'll actually be able to take out. The higher the industry risk, say trying to invent new medicines or other chemicals, there's a lot of risk there, so they can't get a lot of debt. If it's a low risk investment, like say a utility, then you tend to see a lot higher debt to equity ratio because there's really no risk. People aren't going to stop buying electricity or water. So you have a pretty good cash flow and you can take out a lot of debt without a lot of risk, since your future cash flows will be pretty steady. And then you can leverage that and make investors more money. There's a lot going on with long-term debt. Why? Because long-term debt is such a big piece of understanding our financial structure. Remember, these are our other investors. We have owners that are investors in the company, and we have these long-term debt holders that are our other investors in our company. And we have to keep track of what we owe them and how much we need to pay them in interest and when we have to pay them back and how their investment matches up with what the owners have given us. It's cool stuff. And it all works together so well to provide a good picture, even when companies try to slide some of it off of their balance sheet. Now, when we come back in our last lecture, we're going to talk about our last set of investors, and that is our owners, the ones we typically think of as investors. That's what's coming up next. I'll see you then.